Check out Chinese tech stocks. They've been hammered, off more than 30% from their 52-week highs as China's crackdown looms over these companies. Plus, the SEC is settling new disclosure requirements for Chinese IPOs. Despite the headwinds, our next guest says it is time to catch the falling knife, and he is adding to his positions. Let's bring in Dan Niles, founder of the Satori Fund, which is really interesting, Dan, because what we've heard is just stay away from when we talk to fund managers, portfolio managers on these shows, because it's so hard to predict what China is doing and what it'll do next. Why are you buying?
So 3 weeks ago, Sarah, if you remember, you asked me this question on China, and I said, look, you can't touch any of these stocks. We don't own any of them. We admitted we were wrong buying them after the Archegos meltdown. And so the only time you can get involved is when you see the government finally concerned about what they're doing and starting to back off. And so what you saw on Tuesday, which is what got me looking at the space, is that the Chinese state media controlled by the government came out and said, the markets are misinterpreting what we're trying to do. They could stabilize at any moment. The regulators in China had conference calls with big brokerage houses trying to calm markets. And so, I think it makes sense that if you've wiped out $1.5 trillion in market cap in 3 days, which is what happened earlier this week, at a certain point, that 10% of the population that owns stocks is going to start to get really upset. And I think finally that caught their attention, which is why I'm willing to buy, I started buying a basket on Wednesday, added that basket on Thursday, and added more today while shorting a lot of U.S. stocks that I could balance against it, which have been up a lot. And we've got some charts on our website, danniles.com, that I just published, which is those charts you're showing with more detail on that.
So did you buy DD? Because that's been sort of the poster child for the crackdown.
No, I didn't buy that. We bought a basket of over 50 names, and we just been adding to that because we don't want to take company-specific risks. DD's, I can see why people would get involved in DD, but there was sort of this rumor that they were going to be taken private at $14 a share, and then it was denied, and I didn't want any piece of that, so I stayed away from that.
And what would you be, or what are you looking to short in the U.S. market? Is it strictly as an offset to the Chinese play, or do you actually see some vulnerability in parts of the market here?
No, I definitely see vulnerability. I think, when Sarah had me on 3 weeks ago, we talked about the fact we didn't like e-commerce. We were short Amazon into their results. There was plenty of signs out there that said they were going to have bad results. And if you look beyond that, Twitter had issues with user growth. Before this, even though the results were good. Only one out of the MaFang stocks, so that's Microsoft and Apple plus the traditional FANG names, was up after they reported earnings, and that was Google. And we sold our Google position in the aftermarket because our feelings were that these stocks had run up a ton. We wanted to take that money. So MaFang is up about 20% year to date. If you look at KWeb, that's actually down about 20% year to date. It's down. At its worst, it was down 54% from its highs, which was set in February. And so we just moved that around. And remember, we're a hedge fund, so we're always trying to get the best risk reward and balance out those risks.